Buy low, sell high. This is an investment principle that allows investors to maximize returns and minimize losses. But how does one know when the market is going to be high or low? Movements of financial markets are difficult to predict, while historical performance, fundamentals, and macroeconomics provide meaningful insights. No one surely knows whether asset prices will go up or go down. This makes timing the market a challenging task, even for those who are investment savvy. For long-term investors, one way to build wealth over time is through cost averaging. Cost averaging is a strategy that involves investing a fixed amount of money on a regular basis over a period of time, regardless of the price per unit. Through cost averaging, investors who invest a fixed amount regularly are able to purchase more units when prices are low and less units when prices are high. This technique allows investors to increase profit because the total average cost is typically lower this way. To illustrate, assume that an investor allocates 10,000 pesos into a fund of his choice each quarter. In the first quarter, the fund price is 1 peso per unit, so the investor was able to buy 10,000 units. On the second quarter, the unit price rose to 3 pesos per unit, allowing the investor to buy just 3,333 units. The price continues to move up and down throughout the year, and the investor is able to buy varying number of units every quarter. By the end of the year, the investor has put in a total of 40,000 pesos and was able to accumulate 20,833 units. To compute for the average cost, simply divide the total invested amount by the total number of units purchased. This gives an average total cost of 1 peso 92 centavos per unit. In this example, the only way the investor could have achieved a higher return is if the entire amount was invested during the first quarter when the unit price was at just 1 peso. At an average price of 1 peso 92 centavos, the investor makes a gain on 3 out of the 4 quarterly unit prices. One can really tell what would happen to the financial markets. A wealth-building strategy like cost averaging becomes a very useful technique, as it protects investors against market volatility, enhances long-term return potential, and encourages disciplined and regular investing.